Hi, my name is Derek. Welcome to my capstone project video. I'm going to introduce you to interest. Interest is a powerful force in the world of finances, and proper understanding of it is vital to the wise expenditure and investment of money. Interest, as defined by Investopedia, is the charge for the privilege of borrowing money, typically expressed as annual percentage rate, APR. Money lending is a service. When lenders issue loans, they expect a return for the service and for the time that they don't have that money to do something else with. The lenders, often banks, get this return by charging for the privilege of borrowing money with a percent of the total loan. Both the interest owed and the principal amount borrowed is then paid back at fixed intervals over the total loan period. What is important to understand about interest is that the amount you owe to the lender will be greater than the amount you borrowed. When interest is high or the loan period is long, interest can make a small loan turn into a huge debt that can take lots of money and many years to pay off. On the flip side, you can make interest work for you. When you put money into a savings account, for example, the bank will pay you interest. The amount you deposit will grow as interest accrues. Though, the amount of interest a bank pays is usually far lower than the amount of interest you would be required to pay on a loan. Another situation in which interest is critical to understand is with credit cards. Credit card companies charge interest on any incurred debt at the end of the month, so it's important to keep up with your credit card payments. When you miss a credit card payment or pay only the minimum amount due, you will begin to pay interest on the amount owed plus the interest penalty incurred. It is valuable to know the interest rate charged by the company. Always compare the interest rate charged by the different companies and choose the lowest rate offered. Whenever you take out a loan, you should first consider how you will pay it back. There are a variety of variables associated with different types of loans, and these variables will affect how much, and how often you are charged for the original loan amount. Before obtaining a loan, consider 4 things. Interest rate. The higher the interest rate, the larger the amount you will need to pay back. It is most often to your benefit to choose a loan with the lowest interest rate. Compare your options. Consider the monthly payment and your ability to make the payment. If you cannot comfortably pay the balance due each month, do not take out a loan. The penalties for missed payments and the interest payments, which will be added to the loan, can cause a spiral effect which will spin you into debt you cannot get out of. Consider the type of interest being charged, simple or compound. A compound interest loan will result in a larger amount owed than a simple interest loan. However, one rarely finds a simple interest loan offered in financial markets. The length of the loan period. The longer the loan period, the larger the amount owed, the smaller the monthly payments. You will reduce the final amount due on your loan if you can pay back your loan faster. Rather than just paying each monthly payment due, whenever you can, pay back extra each month to reduce the overall debt. Now that we've discussed the importance and implications of interest, I will discuss the differences between simple and compound interest. There are 2 basic types of interest, simple and compound. Simple interest increases money owed linearly. Compound interest increases debt exponentially. Simple interest is only paying interest on the principal, the amount borrowed. You are charged interest on the total amount borrowed, and payments are then evenly divided over the payment cycles, usually monthly. The calculation for simple interest loan is provided on the current slide. The annual percentage rate is divided by 12 months and multiplied by the principal, and the number of payments. I divided by 12 times P times N. This portion of the formula gives you the amount of interest you will be paying. When you then add this to P, the principal, you will have the final value, or, in other words, the total loan amount that you must pay back. To determine your monthly payment, you will then divide the final value by the number of payments. Let me give you an example to illustrate the simple interest formula and calculations. For example, you take out a 1-year loan for $10,000 with simple interest at an annual interest rate of 20%. What is the interest owed? What is the total amount owed? What is the payment each month? P equals $10,000, I equals 0.2, and N equals 12 months. Plugging these numbers into our formula, you can see in column 1 that on $10,000 you will owe $2,000 in interest alone. As you can see in the second column, that while you have borrowed $10,000, you must pay back to the lender $12,000. Column 3 shows that in 1 year, you must make 12 payments of $1,000 to pay off your debt. As I mentioned previously, simple interest increases the amount owed linearly. In order to illustrate this principle, I have increased the debt length to 10 years. Now you can clearly see that you are paying the interest based upon a fixed payment over time. Remember earlier when I said that you should consider both the interest rate charged for a loan and the length of the payment period when choosing a loan? Let's take a closer look at these variables. For this example, we are again assuming a loan of $10,000. As you can see in column 1, when your $10,000 loan is for 1 year at 20% simple interest, you will owe $12,000 and your monthly payments will be $1,000. In column 2, when your $10,000 loan is for 1 year at a lower 10% simple interest rate, you will owe $11,000 and your monthly payments will be $916.67. In column 3, when your $10,000 loan is for a longer 2-year period at a rate of 20% simple interest, you will owe $14,000 and your monthly payments will be $583.33. While your monthly payments may be lower over a longer period, the total amount you owe will be much greater. This example shows that there are substantial benefits to having a lower interest rate and paying back your debt more quickly. This same principle applies to compound interest rate loans as well. Let's talk about compound interest. Compound interest is calculated on principal and accumulated interest. The calculation for a compound interest loan is provided on the current slide. The annual percentage rate is divided by 12 months and added to 1. And this total is then raised to the power of the number of payments. Here's the exponential increase I mentioned earlier. And then this is multiplied by the principal. This gives you the final value, or in other words, the total loan amount you must pay back. To determine your monthly payment, you will then divide the final value by the number of payments. Let me give you an example to illustrate the compound interest formula and calculations. For example, you take out a 1-year loan for $10,000 with compound interest at an annual interest rate of 20%. What is the interest owed? What is the total amount owed? What is the payment each month? P equals $10,000, I equals 0.2, and N equals 12 months. Plugging these numbers into our formula, you can see in column 1 that on $10,000 you will owe $2,193.91 in interest alone. As you can see in the second column, that while you have borrowed $10,000, you must pay back to the lender $12,193.91. Column 3 shows that in 1 year, you must make 12 payments of $1,016.16 to fully pay off your debt. You will also notice that while the loan amount period and annual percentage rate are the same as in our simple interest example, the amounts you owe are all greater. And here is the crucial difference between a simple interest loan and a compound interest loan. The simple interest loan charges interest on the original amount owed, the principal. The compound interest loan, however, is charging interest on both the principal and on the interest owed. You're also paying interest on the interest. Let's take a look at a graph of compound interest loan over 10 years. Notice that the line curves steeply versus the simple interest graph, which increased at a steady rate. When interest is charged on the principal and the interest, the amount owed increases and the amount of interest owed increases exponentially. When taking out a loan with compound interest, the amount of money withdrawn is not the only consideration. You must examine all of the variables, including interest rate, payment period, and time value of money. The more quickly you pay back your loan, the lower the final value of your loan. In other words, the less you pay. Some loans will penalize you for early payment, but will compensate by offering a lower interest rate. Missing a monthly payment results in financial penalties and increases the amount you must pay back. Bottom line, do not borrow money that you cannot comfortably make payments on, and always shop around for the most competitive loan terms. It is possible to make interest work for you. Where do you think the banks get the money they use to lend? Much of it comes from the bank's customers who put their money into savings accounts. When you deposit your money into a savings account at a bank, the bank will pay you interest. Why? Because the bank will use your money to loan to other people. The bank will collect interest on the loan, and in turn, will effectively give you a small percentage of the interest they have collected. When you open a savings account, you are lending your bank money, and they are paying you interest. A great way to make money with no risk. Though, admittedly, unless you have millions in savings, the returns are extremely small. Still, free money is free money. The ability to calculate and evaluate interest is one of the most critical skills for financial literacy. When you understand both the benefits and costs of interest, you will understand how to invest and spend your money wisely. When it comes to loans and credit, always remember to pay early and often. Missed payments can be very costly and bury you in debt. Thank you.